From the June meeting where Federal Reserve Chairman Jerome Powell and company are widely expected to announce a half percentage point hike in interest rates. Now, the Fed funds futures markets are already projecting a 50 basis point jump for both June and July. But investors, the business world, and the markets are laser focused on September. Right now, the markets see the probability of a quarter point hike at 28.5%, but the odds of a half point hike in September, 60.6%. Here in studio with me in a Fox Business exclusive, Nataline Securities Global Fixed Income Head, Andy Brenner, and Euro-Pacific Capital Chief Economist, Global Strategist, and the host of the Peter Schiff Show podcast, Peter Schiff, to game what happens in September. Andy, you first. Now, the Fed obviously is expected to hike by 50 basis points next Wednesday.
That's right.
And then again in July.
That's right.
And then
so
what?
Here. Let me spin it out for you. Tomorrow you have the ECB. Right now the ECB is not supposed to raise rates. But you know what? You've had a lot of central banks raising rates. Today India raised 50. 2 days ago Australia raised 50. I wouldn't be surprised if the ECB actually raises tomorrow. Second thing, CPI on Friday is going to be awful. Even though I think inflation has peaked, and I know my colleague doesn't agree with me, but that's fine. I do think that the number is going to be very high. It's going to set up a very bad tone for the Fed meeting on Wednesday, where I think the Fed's going to have to come out. They're still only going to raise 50, but I think they're going to be incredibly hawkish. So then you're asking me about September. I think July is going to be 50. But by the time you get to September, you have 3 more unemployment numbers, you have 3 more CPI numbers, and I tend to think things are going to moderate a bit. I see the economy really slowing down, and I think there's a very good chance the Fed will only raise 25 in September, but that will not be the consensus until sometime in August.
I'm not sure inflation has peaked. Peter, we are looking at oil in the aftermarket above $122 a barrel. We've got RBOB gasoline up 1.33%. Nat gas is moderating slightly today, but what do you think happens? And don't you agree that the Fed has to raise rates to tamp down inflation?
Well, they have to raise rates a lot more than they've raised them and a lot more than they're contemplating. The hikes that they're talking about are too little too late to do anything about inflation. But more particular, the government needs to dramatically reduce government spending. We need to see big cuts in middle-class entitlements, or we need major tax increases, not on the rich, because that will reduce investment. We don't want to do that. We need more supply. We need less demand, so they have to increase taxes on the middle class, either raise the payroll tax or maybe introduce a national value-added tax or a sales tax. I would prefer spending cuts, but if they don't do one of those two things, inflation is not going to go away. Inflation is going to get much worse. We're nowhere near peak inflation. This inflation is just getting started. I mean, we've had it for a long time in financial assets, but now it's finally moved into consumer goods, and it's got a long way to go.
Andy, the Fed's GDP tracker is pointing toward a recession, and the World Bank is obviously coming out and saying that most countries are headed for either recession or stagflation. Do you agree with that? Are we heading to, and would it be a mild recession? You know, there are different levels of recession.
Liz, the World Bank came out yesterday and dropped their global GDP from 4.1 to 3.2, so that's about a 25% cut. As far as are we going into recession, I mean, I look at what I think Goldman Sachs is at 28%, Morgan Stanley's at 35%, whatever. I do not see a recession. I see a slowdown. I see a slowdown in employment. I see a slowdown in housing sales. I see a slowdown in consumer activity. I look at Target, which in the last 2 weeks have come out with 2 of the worst outlooks that we've seen anywhere. So I see a lot of things slowing down. I'm just not sure.
Peter, are you saying we need a full percentage point hike?
Well, we need more than that, and it should have already happened. But not only are we likely entering a recession, we're probably already in one. Remember, we already got one negative GDP quarter in the bag. The Atlanta Fed just yesterday reduced its estimate for Q2 to 0.9, so we could very easily be in another negative quarter. But this is not just going to be a recession. It's going to be the recession. It's going to be much worse than what we now call the Great Recession, which followed the 2008 financial crisis.
We've got a great tight labor labor market.
No. We have a bigger bubble now than we had in 2008. And when the air comes out of this bubble, it's going to leave a much bigger hangover than the one we had then. The difference is there can be no bailouts this time, no stimulus, no TARP, no QE, because if the Fed tries to do that, if they try to stimulate the economy in the next recession, when inflation is already double digit, and remember, we're not even measuring it correctly. We're using a highly flawed CPI. If we were still measuring prices using the CPI we had in the 1970s and 1980s, we would be closer to 20%.
Well, yeah, I mean, the shelter number is outrageous. It comes in like, oh, there's just a little bit of inflation there. Everybody's rents are going up. But Andy, when you look out and you see that the 10-year yield topped 3%, in and of itself, that's not historically the worst number ever, but where is the investment? Where do corporate bonds go? Where would you be advising people to put money at this point in fixed income?
Liz, I would keep people in the very short end. I really do think there's duration risk, and whether Peter's right or wrong, nonetheless, there's certainly an argument to be made that 10 years could go to 3.25%, 4%. I don't think they're going to go to Peter's 8 or 9% that he's talking about. But nonetheless, I think short Treasuries, I think short corporates make a lot of sense. You can get 3, 4, 5%, and I think that protects you and keeps you out of trouble.
Peter, where does it work to put your money? You have been a gold bug, but you also have other opportunities that you see. I mean, what should investors be looking at the moment from your perspective?
Sure. Gold's a part of my portfolio. It's a small part because it's savings. It's a store of value. Most of my money, personally and for clients, is invested in dividend-paying stocks. I don't like fixed income at all. I agree that if you're going to do it, don't go out on the long end, because that's where you're going to get killed. But even in the short end, you have inflation risk, not as much interest rate risk, but inflation is going to erode away the value of your principal. I own a lot of stocks, mostly outside the United States. I own some companies in the United States, mostly energy companies, but I own stocks that pay me dividends of 5%, 6%, 7, 8%, sometimes 10%.
Well, look at, the Euro-Pacific International Dividend Fund has a very good 3-5 year.
Yeah, I would much rather get dividends from companies than clip coupons on bonds, because the companies that I invest in sell products that people have to buy, not the ones that people want to buy, because they're going to stop buying those. The ones they have to buy, and they'll pay higher prices, and then I can get higher dividends to stay ahead of inflation.
Andy, before we go, give me a grade for Jay Powell and company.
I like Jay Powell personally, and I really think he's the only guy that I've ever seen as a Fed governor, as a Fed chair, that has a business background rather than an economic background. So I would give him a B+ to an A-, but I think it's the rest of the Fed that is really behind the curve.
You're grading on a big curve. No, I would give him an F. But in all honesty, I would flunk everybody since Volcker. They've all done a terrible job.
Classic. Thanks. It's so great to have both of you. You guys have educated our viewers. I don't know which side they take, but we all just got smarter because of you. Andy, Peter, good to see you. Consumer inflation in May skyrocketing 8.6%, hotter than expected, which indicates the 75 basis points of hikes the Fed already implemented are not working yet to tamp down inflation. Immediately at the open, the majors buckled under the weight of that CPI number. Even the core rate, which leaves out food and energy prices, came in at a hotter than expected gain of 0.6%. Right now, we're looking at the Dow, down 667. Flip it over to the S&P. You can see there is a real struggle here, down 92 points, again, off the lows. And as I said, the NASDAQ down 351 points. Fear has a firm hold on the markets, with the volatility index, the VIX, rising at this moment. And let's get, as we see it right now, we look at the VIX. I can pull that up. There we go, up 6.7% to 27.8. So with all of this happening, let's bring in the floor show. We are joined by Euro-Pacific's Peter Schiff, who just 2 days ago on this show adamantly and now correctly predicted we are far from peak inflation. Peter, we rarely, if ever, bring the same guest back, let alone, in the same month, but the same week. You were just on Wednesday, but something struck me that you said that you said it very confidently, we are nowhere near peak inflation. Then we get this number, and it clearly indicates that you were correct. Do you anticipate an intra-meeting rate cut, almost an emergency type of situation, or a 1% hike, rather, a hike in interest rates. What does the Fed do next to get their arms around this situation?
Well, I don't think they're going to do something intra-meeting. They meet next week. But they should. They should raise interest rates by a lot more than 100 basis points. But even if they were to raise them by 100 basis points today, it's too little to make a difference. It's not going to solve an inflation problem. This has been 12 years in the making. The Fed has been flooding the economy with inflation since they launched QE1, and now we're drowning in it. And there's no way to mop up this mess with, 1-2%
not even, hold on,
hikes.
Peter, not even a 75 basis point hike in July, which is what the markets are pricing in. That will do nothing.
Liz,
that's water off a duck's back.
Inflation is 8.5%, and that's if you believe the CPI, which I don't. It's actually more than twice that. If they raise interest rates 1%, rates will still be under 2%. That is a highly inflationary monetary policy. The Fed needs to slam on the brakes, not ease up on the gas pedal. We need interest rates above the rate of inflation. We're not even talking about getting anywhere near the rate of inflation. And we need the federal government to cut spending dramatically. They have to eliminate the budget deficit. The inflation is coming from deficit spending that's financed by money printing. And we've been doing it for a long time. It is a huge tax on the American public, and it's not going to go away.